I want to dwell on the role of currency exchange traded funds in enhancing stock market diversification. You can diversify from stocks by investing in currency exchange traded funds. Currency exchange traded funds allow investors to gain exposure to foreign currencies without directly trading them. It is less risky. So the ETFs play a significant role in stock market diversification by offering unique benefits. And so here is how it functions. Number one is exposure to currency movements. Exposure to currency movements. So currency ETFs, track the performance of a specific currency or a basket of currencies, providing investors with an opportunity to profit from changes in exchange rates. And so this can serve as a diversification tool in a portfolio that is otherwise concentrated in stocks, offering a hedge against currency risk. So you can diversify away from stocks into foreign currency by investing in investing in foreign currency or currency exchange traded funds. Number two is hedging against currency risk. Hedging against currency risk. So for investors holding foreign stocks or bonds, currency fluctuations can impact returns considerably. So currency ETFs allow investors to hedge against potential losses caused by unfavorable currency movements. For example, if an investor holds European stocks and the euro weakens, a euro-dominated ETF could offset losses due to currency decline. So it's a very important, hedging strategy. Number three is diversification, beyond domestic markets. Diversification beyond domestic markets. Currency ETFs allows investors to diversify their portfolio geographically. By investing in currencies of emerging markets or other countries, investors can gain exposure to economic growth in regions that might be, underrepresented in their stock holding. So it's a viable means of diversification, beyond your home country. So you could do that through currency ETFs. Please like this video and subscribe to this channel if you've not done that. It will encourage me a lot. Number four is low correlation with stocks. Low correlation with stocks. So currency ETFs can or do often exhibit low or negative, correlation with traditional stock market. They don't move in same direction. They don't move in tandem. They don't really correlate. There's no correlation between the stock market and the foreign currency market. So when stocks are underperforming, currency movements, especially those driven by macroeconomic factors like interest rates or inflation, may move independently, providing a cushion against stock market volatility. This can help reduce overall portfolio risk. Number five, strategic asset allocation. Strategic asset allocation. So currency ETFs, often offers a strategy. It offers a strategic way to, allocate, assets within a diversified portfolio. Investors can use them to adjust their exposure to specific economic or regions without needing to directly buy foreign stocks or bonds. This allows for more precise management of risk and returns in a broader investment strategy. Number 6, access to global markets. Access to global market. Investing in currency ETFs makes it easier for investors to access global markets, particularly for those who may not have the resources to or the expertise to trade foreign currencies directly. For people like us that cannot really trade currencies directly, so it's advisable we invest in currency ETFs. At least we will not blow our accounts by so doing. So the ETF provides an efficient and liquid way to gain exposure to currencies like the US dollars, euro, the Japanese yen, or emerging market currencies. It's a very, very, it's a very nice, way of investing. Instead of dabbling in forex, trading yourself and losing money as a result, you could adopt this strategy. It will be of tremendous help to you. So in conclusion, currency ETF enhance stock market diversification by offering exposure to currency movement, helping hedge against currency risk, and providing access to global markets. So you want to diversify away from stocks, and you want to diversify away from the volatility inherent in the stock market. You could buy a currency ETF. They invest in different pairs of currency, and so you are good to go. These tools are valuable for managing portfolio risk, particularly in a world where currency fluctuations can significantly impact returns from both international stocks and bonds. So it's important actually that if you are so keen about gaining from the forex market, from forex trading, and you cannot trade yourself, and you have no desire, you don't really want to learn to sit down and acquire the necessary knowledge, then the best option for you is to buy a currency ETF. That would be a viable means of you participating in forex gains. Because if you try it yourself, you may end up blowing your account if you don't know what you are doing, or if you've not really obtained the skills, the experience, and the knowledge that will help you succeed.